is someone we've known for a long time now. I think Shantanu used to be based in India, was an advisor to many companies that we were evaluating back in 2012 when the Bombay ecosystem was taking off. Since then, he's now moved to the Valley. He spends his time across the Valley and Asia, and he advises companies on multiple things largely related to legal. And the reason we thought we'd do this was cap tables is a topic that many people are interested in, especially as they're starting out. Shantanu, thanks for doing this. Really appreciate it. First off, I think, what is the significance of a cap table? Why is it important? And how is it different in India versus the US?
Sure. Thanks, Rajinder, and thanks everybody for showing up. I know Monday evening is not really popular, particularly in heavy traffic time, so thanks again for coming. So, as Rajinder mentioned, I was in India. I'd like to think I was one of the first folks involved in the ecosystem here since 2007. I'm now back in the US in the Valley, and I'm a corporate lawyer from KWM, based in Palo Alto Menlo Park area, which many of you will know that's sort of the epicenter of the startup scene, at least in Silicon Valley. So at the very outside, what is a cap table? Clearly, it's some kind of a table. You can do it on Excel or any other spreadsheet you want. Excel is pretty popular. In the US, we also have a number of software providers that are pretty popular. You can go online and see any of these. In India, I don't know if anyone, do people here use it? Yeah. But fundamentally, it is the way that you decide the equity in the company. But it's more than that. It's the story of the company, in fact. And the reason lawyers get very involved in the cap table is because the cap table is based on legal documents. And one of the key differences I see is that the lawyers are heavily involved in cap tables in the US. Here, I think cap table is probably much more of CFO or the founder is more involved in that. There, they tend to be a little bit hands-off on that approach. But I think before we get into that, I want to just tell you about three terminologies that I think everybody should understand in cap table. So one is pro forma cap table. So probably many of you have heard of this word pro forma, Latin term. And basically what it means is matter form, right? Pro forma simply means that when you're doing the cap table, you're basically planning the cap table as if a transaction has occurred. So when in the legal world, when we say a cap table, we say that that's as if fully diluted, basis, right? So fully diluted, which you would have heard of, is fully diluted as converted basis. Means that every transaction, everything that could have occurred has been accounted for in this cap table. All your stock options, all your warrants, convertible notes, all your promissory notes, whatever it is that you set out, stock options, etc., has been sort of taken into account in this cap table. That's the fully diluted. So the pro forma is basically telling you what the cap table will look like post-transaction.
Quick follow-up on this one. So in the US, you have common practice of rounds getting structured more as safe notes, whereas in India, it tends to be largely priced rounds. How does that affect the cap table, and what's your advice on this?
Yeah. No, that's a very good point. I think one of the things in the US is that, just in my experience, rounds tend to happen very quickly in the US. And part of that, I think, is always the ecosystem is fairly mature. The other is the legal documents have actually been slimmed down to a large extent. Typically it's the three basic instruments you find in the US: convertible notes, safes, and then something called KISS, which is kind of almost similar to a safe in a way. Safes really became popular in the last 3 or 4 years. You didn't hear about them before that. It was popularized by one of the famous incubators and accelerators in the US. It's also almost geographic that convertible notes are actually more popular on the East Coast, and safes are more popular on the West Coast. And that may be a little bit broad, but that's kind of what you see. You don't see that many safes actually outside of Silicon Valley. For some reason, I think it's just more of a Silicon Valley thing. But you can still have a cap table with a convertible note. The issue is that when you do the cap table, you will not be able to necessarily determine the number of shares that is going to be attributed to that safe or convertible note, simply because usually what happens, the purpose of the safe, convertible note, case, etc., is actually to kick what we call kick the can down the road, right? You're basically pushing off that valuation discussion for another day, right? And the reason why actually it's probably good for both parties in some way, is because it is hard to determine a valuation very early stage of the company. And what is a valuation determined on? It's determined on several factors, like revenues, total addressable market, customer base, et cetera, right? And product. But generally, it is very hard to determine that valuation, and therefore, the practice, at least in the U.S., typically has been to kick the can down the road. I know in India, it's probably less common, and typically there's more of an insistence on pure valuation, sort of, we're going to peg it at a certain amount. I'm not sure it's, maybe it's a cultural thing also, that people want to know exactly what they're getting. I mean, there's some element of what's behind the door in a convertible note, or let's say, because there isn't a valuation, right? Now, there are ways that an investor can protect themselves. Like, for example, you can have a valuation cap, for example, that basically the valuation will basically be capped at a certain level, and if the valuation goes above that, then the investor actually benefits. So those are some things we do see in the value that you can have, your KD and 2 that basically, okay, we won't have a valuation, we will cap it at a certain amount, and that's investor side protection, right? The investor actually will benefit from having a valuation cap on that front. You have a discount ratio, right? So you have a discount to the convertible note, typically 10 to 30% is what you typically see, just for that risk reward. An investor has invested in the company, and therefore gets this discount. But typically, the profile of somebody doing either a convertible note, say for a case is going to be an angel investor, or a quasi-institutional accelerator, incubator, that sort of thing. VC fund would be able to do something like that.
Technically, how are these three instruments different?
No, they are actually legally different also. And again, apologies that this is more in the U.S. context, because they don't necessarily translate entirely into India. Although there is some elements of doing that. For example, in India, we call it convertible note. In India, I've seen the use of convertible debenture. The term debenture is used much more. And also, when you have, I've run into this issue when you have, for example, an Indian company and you're taking money from overseas. So a note is essentially a debt instrument, right? It's essentially that's what it is. And the problem is if you are an Indian company taking debt from a foreign party, the issue is can you pay that debt back to a foreign party? The answer, at least from what I have experienced, is no. And so an actual convertible note has to be what they call a fully convertible note into India, right? So it cannot be a note that technically can be paid back. So you must structure it as a fully convertible note. That's one slight nuance when you're dealing with a foreign investor. They have to be structured as a fully convertible note, otherwise there are problems with that structure. If you're dealing with a domestic investor, I think you have a lot more flexibility to structure it as a note. And essentially, it is different from, say, for a KISS because it is a debt instrument, essentially, right? It is a promise to pay back money at a certain point in time. There's a maturity date, typically 1 to 3 years is going to be the maturity date. There's going to be an interest component also. And then there's going to be some conversion criteria, threshold. There's something that will cause that convertible note to convert into equity, right? And typically, it's going to be the next round of financing, right? That's typically what it is. And there's actually three outcomes, right? Next round of financing. The second would be some kind of acquisition offer. For example, suddenly you got an acquisition offer, then the note holder would convert. The third would be a maturity event, where basically, eventually, after 3 years, they just get it over back with the interest, right? And typically, in the venture scenario, nobody really wants to get their money back in the sense that people are investing in these really to convert it into equity, right? This can be distinguished from a SAFE, which is stands for Simple Agreement for Future Equity, right? And so it's this hybrid instrument where technically it's not really a debt in some way, but basically it's an agreement saying that I'm going to give you money and it's going to be an agreement that will allow me to get equity in the company. In the same way, the sort of wrinkle or loophole is what if the company never raises money? What happens? Right? At least in the note, you can call the note and get your money back. In the SAFE, that is a sort of wrinkle in the SAFE. Now, the reality is, again, most people who invest in safes are, again, looking for a conversion, right? And they're usually experienced angel investors who are investing in many startups. They're not really looking to get money paid back in the same way. But that's sort of the technical legal definition. One is a really sort of almost a dead instrument. The other is not really a dead instrument. I've not seen states, and you can describe this market, whether it's used in India that much. I know there's something called an iSafe. I know one of the VCs here has authorized that. I don't know if you see this in your general market. You see that?
Many people here will be hopefully preparing a cap table pretty soon as they build their company. What should the ideal cap table have? Like, what are some of the basic mistakes to avoid?
The biggest example in the world, if any of you saw the movie The Social Contract, the entire movie was about a promise for a certain amount of equity in Facebook, right? So even in the U.S., a sophisticated market where you created a very large, one of the largest companies in the world, this sort of thing happens all the time. So it's not unheard of that basically there are promises made and people come out of the woodwork later on saying, hey, you promised me, we met at a bar one night and you wrote down a napkin and I get 2% of the company. I'm going to come back with my 2%, where is it? So you do see this. So it's very important that all these things be documented. So I think that is one of the key sort of elements, mistakes, is that it's all documented, and it's hard because initially everybody's friends or your family members who are investors or whatever, but there is some element of formality because future investors like Matrix are going to want, they don't want a surprise.
What are the big mistakes other than you're not documenting things?
Yeah, no, that's a very good question. So I was talking more at a very early stage. As you get into later and later rounds, for example, I'm doing a Series F now. And a Series F typically can be north of $100, $200 million, right? So that sort of level, all these factors become compounded because you have, all the way to Series F, you have A, B, C, D, right? Plus you have seed round and you have major round before that. So then your spreadsheet or your Excel sheet or cap table becomes very complex, and you have layers upon layers of scenarios and basic preference. Then you also have what they call participating preferred. So I don't know if you see that in India as well.
I mean, we see it, but we don't believe in it. We don't ask for it from founders, and we don't give it or advise our founders to do it.
Got it. So I just explained what it is. It's nice that Matrix doesn't impose it. It is something you do see maybe from others in the market, but certainly in the U.S. context you see it. But essentially, when you have a participating preferred, the VC will get their 1x or whatever. Let's say they put in $5 billion, they'll get their 5 and then their 1x upon a liquidation event. Plus, they will convert into common stock or equity shares in India, and then they will participate again on a pro rata basis. So basically, they're double dipping. And I see this a lot where I think a lot of founders don't necessarily understand this context. The legal documents, they're buried. It's buried in sort of 1 or 2 sentences, right? But it has an outsized impact on your company.
If I could just break it down into an Excel template for you, there are 3 big variables that change the capital. One is, of course, your pre-money valuation. 2 is, who are the investors and how much are they investing? And then 3 is, what does the cap table look like today? Because what most people forget is they just focus on the first 2. What they forget is the third part. So you don't actually know the number of shares that are outstanding as on date, because your price per share and everything else gets derived from there. So I have seen multiple examples of situations where founders have said that, oh, we have 1 lakh shares outstanding, and that's what's been issued out for founders, and we carved out something for ESOP. And then when you later on do some basic diligence, you realize that it wasn't 1 lakh, it's actually 1,15,000. That, oh, we actually issued out these shares to one other departing co-founder, but he's left the company, and there are all sorts of issues that you then need to take.
Just one more thing on the cap table that I wanted to talk about was I see a lot of recapitalization, and what I mean by that is that companies, and you have some of your portfolio, that essentially flip or move their jurisdiction of incorporation for various reasons. And I see this as an increasing trend for certain types of companies. For example, certain companies reincorporate in Singapore for various reasons, become a very popular jurisdiction now. A certain B2B SaaS is a very hot sort of area for investors, and a lot of those companies do reincorporate in the U.S. in Delaware in particular. So we often get calls about an Indian company which is incorporated in India, and now because they're planning always to do a B2B SaaS play, and they want to reincorporate it in the U.S. in particular. So then how do we recreate that cap table? So for example, the math is slightly different in India versus 1 lakh shares. In the U.S. we have a slightly different model in terms of that. And then there are RBI questions in terms of how to recreate the cap table, particularly for Indian tax residents. How do we get their shares in a U.S. company? So there's some complexity around flipping that structure. And just in general, If somebody is planning to flip the structure, it's better to do it earlier than later, because the longer you delay it, then it's almost impossible to flip it.
My name is Raj, and a question for both of you. For companies which are moving beyond seed towards Series A and setting up ESOP pools, any advice you have of how that can be designed so that when the Series A guy comes in, or when folks like yourself come in and look at it with a magnifying glass, you find everything as it should be?
Yeah, I would say first and foremost, create the ESOP pool. I think the other thing is you need to be clear on who's been allotted how much, because the one big thing that VCs will care about is how much of that pool has already been allotted or verbally at least promised, right? You may not have a formal ESOP policy that's already laid out, and people may not have been given any formal communication. But if there has been some commitment made, then key employees, and you do want to clearly lay it out, because what investors care about is what is the unallocated pool, because that's the pool that needs to be created, because in future key employees to be part of this company's journey. I think the third thing is, if things have been set up, it should have ideally been run through by a lawyer, because many people actually pick up documents and try and modify them. You do want to work with a lawyer to make sure that you craft the policy right, and some people do it via trust, some people do it via just a pool. Some of the difference.
And I think the most important part of that really is the promising. Really, that's really what I see. So typically, once it's all set, everybody has a stock option agreement. You have a stock option plan. That's after everything's been done. It's usually more complex and there's more contentious before that, right? Because again, I was promised a certain amount, right? So you're trying to recruit 5 engineers, and you're going to tell each one of them you're going to get X and Y. Right? Again, it's typically better to do it as a raw number as opposed to a percentage, because the percentage is always up for interpretation. That's not the best practice.
Another simple best practice is, at an early stage, the best way to communicate to people who are joining the company is more in terms of the multiple of their compensation. Because most people think of it in terms of, hey, if I'm being paid X in CTC, then what is it in ESOPs? I see a lot of people saying, hey, you've been given out X percentage of the company, or you've been given Y shares. Of course, an employee is going to ask, what is the value of these shares? And I find that the easiest way to communicate that is, what is that relative to your CTC? At an early stage, one is I think very generous, but not unheard of. As companies kind of grow, generally that number again tends to vary. You generally see that number kind of again similar in that range, because everyone's trying to kind of calculate how much of a multiple of this can I really earn over a period of time. So if I've been given, say, 20 lakhs of equity at a Series A stage, assume that company goes on to become 100x of where it is today. Assume that the price per share doesn't go up 100x, but probably because of dilution it goes up, say, half of that. And that employee stands to make 50x on the value of the ESOP that they've been promised up front. So that's a huge number, right? And so it's always more important when you're communicating to people joining the company that, hey, you're getting X lakhs or X worth of equity, and the future opportunity is this if the company achieves what it wants to achieve in terms of growth and valuations.
Thanks. Both of you again. This is Akshat Birla, running a fintech company called Fairway Capital. One question which we grapple with is, how do you incentivize advisors? Because how do you create an advisory pool in addition to the ESOP pool without creating a tax liability which is immediately applicable to these guys because they're not employees of the company?
Well, that's a very good question. How do you incentivize advisors to stay in your company, especially if they're busy people? In the US form, it's a little bit easier because you can allocate them shares, and I have seen that. Particularly if you're in discussions very early on, then they're almost quasi co-founders in a way, because you can actually issue them very low price stock, for example, so they can buy the shares at a low price. But if they come in later, then you're right, it's very difficult at that point because now the valuation's gone up and you can't really issue the low price stock. So this is really the other way, some kind of ESOP, or in the US we even have what they call phantom ESOPs. That you basically kind of market, but basically it would be phantom in the sense that they will get paid out in cash.
Listen, thank you everyone. Shantanu, thank you. You've been patient with all the questions that you had, and
Thank you for tuning in. And you can find the transcribed version of this podcast on matrixpartners.in. You can also follow us on Twitter and LinkedIn for more updates.